Hello, and welcome to Arnerich Massena's second quarter 2019 MarketCast. Following a blockbuster first quarter, U.S. stocks closed the second quarter higher, despite a backdrop of trade wars and moderating economic growth. With the U.S. expansion now past the 10-year mark and the longest on record, we believe it's important investors maintain a well-diversified portfolio, which, coupled with an active rebalancing strategy, can capture returns wherever and whenever they occur. Senior Research Analyst Arthur Coyne and Senior Investment Advisor Reegan Rae are here with me today to recap the quarter and look at how we are implementing portfolios in the current environment. Thank you for joining us today.
Thank you, Brian. In the second quarter, stocks rose, then fell, then rose again on uncertainty around the U.S.-China trade war and Federal Reserve monetary policy. Stocks climbed early in the quarter on hopes that a U.S.-China trade agreement would bring an end to the year-long trade war. But by early May, talks stalled, and stocks moved lower, with the United States and China increasing tariffs on each other. And further adding to May's uncertainty, President Trump tightened sanctions on Iran and threatened Mexico with a new across-the-board 5% tariff. Fortunately, the downturn was short-lived, and by June, investors had regained confidence thanks to improving trade relations with China and Mexico and signs that the Federal Reserve might soon be cutting interest rates. By the time the quarter ended, the S&P 500 index had scored a 4% gain and was back near an all-time high. Looking at second quarter's performance, stocks rose around the world, with the United States leading the way. And bond prices also rose as interest rates fell on signs of slower growth. However, the US dollar gave back some of the appreciation that it's had over the past year. All told, through the first half of 2019, returns have been very strong and well above average across the board. Now, to get an idea as to where the economy may be heading, let's look at the Conference Board US Leading Index of 10 economic indicators, which combines a broad array of predictive indicators such as manufacturing orders, building permits, labor, credit, expected business conditions, and interest rate spreads. And here we see that through May, the leading index was continuing to signal growth for the United States economy, but at a moderating pace. This is consistent with a recent Bloomberg survey estimate that second quarter annualized growth slowed down to about 1.8% versus first quarter's actual rate of 3.1%. As long-term investors, it's important to step back and look at the market's longer-term trends. In this chart of S&P 500 sector weights, we see some major shifts that are happening in the U.S. economy. Most notably, between 1990 and today, the U.S. economy has been transitioning from an old industrial economy to a new information-based economy, where the leading new economy sectors, information technology and communication services, have grown from 15% in 1990 to 32% today, while the old economy sectors, including consumer staples, industrials, utilities, energy, and materials, have declined from 54% in 1990 to 28% today. And lately, the market weight of the new economy has been accelerating. The new economy is now valued above its long-term trend line, while the opposite is true for the old economy. Another long-term trend that we have our eye on is that China is becoming a much bigger part of the investable stock market. Here we see that in the MSCI Emerging Markets Index, China's weight is projected to rise from 30% today to 56% by 2022. This highlights the importance of China as the world's second largest economy and its ability to attract foreign investment. And now, to look at our positioning in a portfolio context, it's my pleasure to introduce Senior Investment Advisor Reegan Rae.
Thanks, Arthur. With U.S. stocks near an all-time high, we're seeing this as a great opportunity to rebalance and diversify portfolios to include attractive, undervalued investments. In particular, we're tilting toward international equities, including emerging markets, and we are leaning into value stocks, which have been trading near a record discount to growth stocks. In bonds, we're favoring low duration, and we've been trimming our exposure to lower credit quality. Where we do invest in credit, we're favoring skilled active managers who can individually assess each credit opportunity. And as always, your advisor will keep you informed about specific investment opportunities as they become available. We're excited about the recent publication of our private equity white paper series. Be sure to take a look if you haven't already. The three-part series covers the why, what, and how of private equity, providing the fundamentals so investors can become more familiar and comfortable with private markets. For more information, please visit us on the web at arnerichmassena.com. Thank you for joining us today.